Assalamualaikum warahmatullahi wabarakatuh. First of all, my name is Muhammad Firzan Hakimi bin Zulfaqar. My matrix number is 152413. Thanks to Dr. Aisha as our course coordinator for SEP 403E, Seminar in Contemporary Economic Issues. I would like to present my creative content task about monetary policy in Malaysia and also explore the sustainable development solution. Basically, monetary policies refers to the set of actions and measures implemented by a country's central bank or monetary authority to manage and control the supply of money and credit in the economy. The primary objective of monetary policy is to achieve specific economic goals such as price stability, full employment, and sustainable economic growth. Central bank use various tools and instruments to influence the money supply, interest rates, and other financial conditions in the economy. One of the primary goals of monetary policy is to control inflation, ensuring that prices remain stable over time. Central banks set target inflation rates and use monetary tools to prevent both high inflation and deflation. Stable prices provide a conducive environment for economic planning, investment, and consumer spending. By influencing interest rates and credit conditions, monetary policy aims to foster a favorable environment for economic growth and job creation. Lower interest rates can stimulate borrowing and spending by business and consumers, leading to increased investment and employment. Central banks, through monetary policy, manage interest rates to achieve specific economic objectives. For example, reducing interest rates can encourage borrowing and spending, while increasing rates can cool down an overheating economy and control inflation. The overnight policy rate (OPR) is one of the most crucial tools employed by Bank Negara Malaysia (BNM). It represents the interest rate at which banks lend and borrow money from each other on an overnight basis. BNM sets the OPR to influence the overall level of interest rates in the economy. When BNM raises the OPR, it becomes more expensive for banks to borrow money, leading to higher interest rates for consumers and businesses. Conversely, a lower OPR makes borrowing cheaper, stimulating economic activity. The Statutory Reserve Requirement (SRR) is a tool that involves regulating the amount of funds that banks are required to keep in reserve, which is non-interest bearing, with the central bank. BNM sets the SRR as a percentage of certain liabilities like deposits that banks hold. Adjusting the SRR affects the amount of money banks have available for lending. Increasing the SRR reduces the amount of money banks can lend, acting as a contractionary measure. Conversely, decreasing the SRR provides banks with more liquidity for lending service as an expansionary measure. Open market operation (OMO) involves the buying and selling of government securities bonds in the open market. BNM conducts OMO to influence the level of reserve in the banking system and consequently short-term interest rates. When Bank Negara Malaysia (BNM) buys government securities, it injects money into the banking system, increasing the supply of money and potentially lowering short-term interest rates. Conversely, selling government securities removes money from the system, reducing the money supply and potentially raising short-term interest rates. These tools collectively help BNM achieve its monetary policy objective, including price stability, economic growth, and financial stability. The central bank carefully considers economic indicators such as inflation rates, employment levels, and overall economic activity when deciding on adjustment to these monetary policy tools. It's important to note that these tools are often used in combination, and the effectiveness of each tool depends on the prevailing economic conditions. Central bank, including BNM, continuously assess and adjust these tools to respond to changing economic circumstances and maintain a balanced and stable economic environment. Malaysia, like many other countries, employs an inflation targeting framework as a key component of its monetary policy strategy. Inflation targeting involves setting a specific inflation rate as the central bank's primary policy objective. The aim is to maintain price stability within a defined target range. For Malaysia, the inflation target is typically communicated as a point target or a target range over a specific period. As of my last research update in January 2022, Malaysia has employed a flexible inflation targeting framework where the central bank, Bank Negara Malaysia, targets a headline inflation rate. This framework provides some flexibility, acknowledging that short-term fluctuation in inflation may occur due to external factors such as global commodity prices. The targeted inflation rate in Malaysia has varied over time, but it is commonly set within a specific range. As of my last research, the target range has typically been around 2% to 3%. This range allows for some flexibility, recognizing that precise control of inflation can be challenging and that certain external factors such as fluctuation in global oil prices can impact domestic inflation. When Bank Negara Malaysia observes that inflation is rising beyond the target range, it may decide to increase the OPR by raising interest rates. BNM aims to make borrowing more expensive for businesses and consumers. This has a cooling effect on spending and investment, leading to a slowdown in economic activity. The reduction in demand helps prevent the economy from overheating and putting upward pressure on prices. Conversely, when inflation is below the target range or the economy is experiencing a slowdown, Bank Negara Malaysia may choose to lower the OPR. Lower interest rates make borrowing more affordable, encouraging business and consumers to spend and invest. This increased economic activity helps support job creation and, in turn, contributes to a gradual increase in inflation toward the target range. Bank Negara Malaysia carefully monitors a range of economic indicators including inflation trends, economic growth and employment levels. The decision to adjust the OPR is based on a thorough analysis of these indicators and an assessment of the overall economic conditions. Malaysia operates under a managed float exchange rate system. This means that the exchange rate is allowed to fluctuate based on the market forces, but the central bank, Bank Negara Malaysia (BNM), may intervene to prevent excessive volatility and ensure stability. Malaysia does not have a fixed exchange rate, but also does not allow the currency to float freely without any intervention. A managed exchange rate allows Malaysia to maintain competitiveness in international trade. Bank Negara Malaysia may intervene in the foreign exchange market to prevent rapid and drastic fluctuation in the Malaysian ringgit. This stability is beneficial for business engaged in international trade as it provides a predictable environment for pricing and planning. The exchange rate influences the price of export and imports. A stable or competitive exchange rate can support Malaysian exporters by making their goods more attractively priced in foreign markets. On the other hand, it can influence the cost of imported goods, impacting domestic consumers and businesses. A managed exchange rate can contribute to maintaining a stable balance of payments. Bank Negara Malaysia may intervene to address trade imbalance and ensure that the country's external accounts remain sustainable over the long term. It's important to note that exchange rate policies can evolve over time based on economic conditions. Central banks like BNM continually assess and adjust their strategies to address changing circumstances and support the overall economic well-being of the country. For the most up-to-date information, it's recommended to check the latest reports and release from Bank Negara Malaysia or the authoritative sources. Malaysia is a major exporter of oil and natural gas, Therefore, changes in global oil prices have a direct impact on the country's revenue, trade balance, and inflation. Higher oil prices can contribute to increased government revenue, but they may also lead to inflationary pressures. Conversely, lower oil prices can affect Malaysia export earnings and government revenue but may ease inflationary pressures. Besides oil and gas, Malaysia exports other commodities such as palm oil, rubber, and tin. Fluctuation in global commodity prices, especially for key exports, influence Malaysia export revenue, trade balance, and overall economic performance. Monetary policy may be adjusted to respond to the economic implication of such price changes. Malaysia's monetary policy takes into account the country's trade balance and current account position. A surplus or deficits in the trade balance affects the availability of foreign exchange reserve. A surplus may lead to the end accumulation of reserve, while a deficit may put pressure on reserve. Monetary policy decisions consider the need to maintain a balance in international payments, and changes in global demand for Malaysian goods and services impact the country's export performance. During periods of strong global demand, Malaysia may experience increased exports, contributing to economic growth. Conversely, a slowdown in global demand may prompt adjustment in monetary policy to support domestic economic activity. Global economic factors influence the exchange rates of Malaysian ringgit. A weaker ringgit can make exports more competitive but may also contribute to imported inflation. A stronger ringgit can reduce inflationary pressures but may affect export competitiveness. Monetary policy decisions, including interest rate adjustment, may be used to manage the impact of exchange rate movement on the economy. Malaysia is exposed to external economic shocks and risks arising from global economic conditions. Events such as financial crisis, geopolitical tensions, or major disruptions in international trade can impact Malaysia's economic stability. Monetary policy decisions may be adjusted to mitigate the effects of such external risks and ensure financial stability. Changes in global commodity prices and exchange rates can contribute to imported inflation. For example, an increase in the prices of imported goods can contribute to rising domestic inflation. In response, monetary policy tools such as interest rate adjustment may be used to manage inflationary pressures and maintain price stability. Malaysian monetary policy decisions are closely linked to global economic factors, particularly commodity prices and international trade. The Central Bank, Bank Negara Malaysia (BNM), assess the impact of these factors on key economic indicators and adjust its policies to achieve the country's economic goals, including stable prices, sustainable growth, and financial stability. During the ASEAN financial crisis in the late 90s, Malaysia adopted unconventional measures. In 1998, Malaysia abandoned its fixed exchange rate regime and implemented capital controls. The Malaysian ringgit was pegged to the US dollar to stabilize the currency and prevent speculative attacks. Malaysia imposed capital controls to restrict the movement of capital in and out of the country. This was done to prevent further depreciation of the currency, stabilize financial markets, and protect the economy from the adverse effects of large-scale capital outflows. Post-global financial crisis 2008 to 2009, Malaysia implemented counter-cyclical measures to support economic recovery. Bank Negara Malaysia reduced to overnight policy rate (OPR) to stimulate borrowing and spending, aiming to boost domestic demand. In coordination with fiscal policy, Bank Negara Malaysia played a role in supporting the Malaysian economy by ensuring adequate liquidity and facilitating credit flow. The central bank's efforts were part of a broader strategy to counter the negative impacts of the global economic downturn. In response to the economic challenges posed by the COVID-19 pandemic, Bank Negara Malaysia, like many central banks globally, implemented interest rate cuts. These rate reductions aim to ease financial conditions, support business and household, and encouraging borrowing and spending. Bank Negara Malaysia also introduced various financial assistance programs and measures to alleviate the economic impact of the pandemic. This included loan moratoriums, liquidity support for business, and regulatory flexibility to ensure the stability of the financial system. Bank Negara Malaysia collaborated closely with the Malaysian government to implement a comprehensive economic stimulus package. This involved fiscal and monetary measures working in tandem to address the multifaceted challenges brought about by the pandemic. Malaysia monetary policy responses to economic crisis and external shocks have involved a mix of conventional and unconventional measures, including interest rate adjustment, exchange rates policies, and targeted intervention to stabilize the economy and financial system. Bank Negara Malaysia's ability to adapt and implement timely measures has been crucial in managing and mitigating the impact of various economic challenges over the years. As digital currencies and financial technology (fintech) continue to evolve, Malaysia may explore the integration of digital currencies into its monetary system. Policymakers could consider the implication of central bank digital currency (CBDCs) and the adoption of fintech solutions for payment system and financial services. Given the global focus on sustainability, Malaysia may incorporate more sustainable finance principles into its monetary policy. Policymakers might encourage financial institutions to consider environmental, social, and governance (ESG) factors in their decision-making processes and support green initiatives. Bank Negara Malaysia may refine its inflation targeting framework, potentially adjusting the targeted inflation rate or considering alternative measures to enhance the effectiveness of monetary policy in achieving both price stability and economic growth. We may implement effective risk management strategies, maintain flexibility in policy responses, and strengthen collaboration with international counterparts to navigate external challenges. We also to adopt a flexible approach, considering a range of economic indicators and communicate their intention clearly to manage expectation and build confidence. In navigating these potential trends and challenges, Malaysia policymakers may need to adopt a forward-looking and adaptive approach, leveraging technology, fostering collaboration, and maintaining a balance between stability and innovation in the financial system. Regular assessment of the economic landscape and a commitment to transparent communication will be crucial in addressing emerging challenges. For the conclusions, Malaysia monetary policy is a dynamic and evolving landscape shaped by both domestic and global factors. The country has demonstrated resilience in the face of economic challenges, implementing a range of policy measures to ensure stability, growth, and financial well-being. Looking ahead, several trends and challenges are likely to influence the trajectory of Malaysia's monetary policy. The potential integration of digital currency, sustainable finance initiative, and refined inflation targeting framework reflect the nation's commitment to staying abreast of global economic trends. Policymakers are poised to navigate the complexities of external shocks, emphasizing effective risk management and international collaboration. As Malaysia anticipates the future, maintaining a delicate balance between inflation and economic growth will be crucial. The challenges posed by digital currency risk, sustainable finance implementation, and effective communication underscore the need for adaptive and innovative policymaking. In facing these challenges, policymakers should consider comprehensive solutions. These involve robust regulatory frameworks for emerging technologies, clear standard for sustainable finance, and transparent communication strategies to enhance public understanding. Ultimately, Malaysia monetary policy is a dynamic tool that will continue to evolve to address the ever-changing economic landscape. With a proactive and strategic approach, the country is well positioned to foster economic resilience, sustainability, and inclusive growth. That's all from me. Thank you, Dr. Aisha.